Hello everyone, welcome to This Week in the Markets. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regard to your objectives, financial situation and needs. Welcome to another random market updates. Today we cover the most despised rally in equities, the Aussie dollar market and copper. More hype in the S&P 500 over the week as the benchmark index broke through 1630, probably becoming the most hated rally of all time, at least for some. Now what makes this market difficult to understand is the lack of correlation between commodities and treasuries. High bond prices are suggesting that everyone is running for cover in safe haven trades, but record high prices in equities are suggesting that everyone is risk on. Now technically, there is an ever increasing divergence between the S&P 500 and the CRB commodity index, as well as the 10-year treasury yield. Not just recently, but this goes back to 1998. Now the market also has diverged against economic indicators including core durable goods and manufacturing PMI, and inflationary expectations. Now how these divergence patterns correct themselves is either the S&P 500 retracing about 10 to 20%, which would broadly bring it in line with economic indicators, or economic data picking up to bring it in line with the markets, or maybe even both. However, if they were to be mutually exclusive, one would be tempted to bet on the first due to the gloomy macroeconomic backdrop. Whatever the case may be, these divergence patterns are bordering historical records, and eventually something has to give. In Australia, employers have added to payrolls 4 times more than estimated. Jobs numbers have come in at 50.1 thousand compared to the estimated 11,500. The unemployment rate also fell to 5.5% compared to the estimated 5.6%. The Aussie dollar reacted sharply to the news, with the pair rallying over 70 pips from its support at 1.017. Since then, however, the pair has erased all its gains and fell further to currently trade just above parity. It is likely that the commodity currency is expected to weaken due to lower commodity prices, mining boom peak, and lower interest rate outlook domestically, coupled with China still yet to show consistent signs of continuing strength in growth. Now the RBA also lowered interest rates in its recent meetings to historical lows, which essentially provide a bearish catalyst to the currency. In commodities, despite a rebound of the 3.1 level, copper has been trending downwards with long-term resistance at 4.5 and medium-term resistance at 3.9. Now the metal has broken through support at 3.30 in April and would need to close above this level to signal a bullish trend. If the metal currently progresses to form a lower high from 3.9 and breaks the 3.1 level, then bearish momentum could well possibly take it down to the $2 a pound level. Given the commodity's vast use in production and manufacturing, it is generally a useful indicator of economic activity. If the price of copper falls, it could signal that business activity and demand across the board is decreasing, and more importantly, negative for traders' sentiment. That type of recessionary environment would be evident of low inflationary expectations, which could be somewhat chaotic for the S&P 500 given its reliance on inflation and liquidity, mainly from the Fed. That's all for this week's presentation. On behalf of Trading Pursuits, would like to wish you profitable trading.